Wonderful. I believe we are good to go. So, hello, welcome from wherever you're joining us today for the second of two webinars on how to account for climate in financial reporting. My name's Sundip Jadeja, Technical Manager at the Climate Disclosure Standards Board, CDSB. Joining me today, Paul Sutcliffe, Accounting Advisory Partner at EY London, and Barbara Davidson, Senior Analyst at the Carbon Tracker. First, just to mention, we have set aside time for questions at the end, so please do send those in throughout today's session using the Q&A function that you find in the Zoom webinar. Quickly first, just to introduce the CDSB. We were set up in 2007 at the World Economic Forum to advance the integration of climate and environmental information into annual reporting, mainstream reporting by companies, for the benefit of investors to aid in their capital allocation decisions, ultimately one of the pieces in the puzzle to transition to a low carbon future. Now, in recent years, the recommendations of the Task Force on Climate-Related Financial Disclosures, the TCFD, have been a significant driver in the improvement of narrative reporting of climate-related information by companies. That being said, there is still a long way on TCFD reporting, and one particular area where improvement is required is a reporting of potential and actual financial impacts of climate-related matters. This has led to a question as to whether climate-related matters that are reported in the front half of annual reports, in other words, management reporting, narrative reporting, are in line and consistent with the numbers and accompanying notes in the back half. And by that, I mean the financial reporting and financial statements. And therefore, there is a concern as to whether investors are being provided with a complete and consistent story with regard to climate in companies' annual reporting. Now, there have been a number of significant developments in this space in the last few years. Both the International Accounting Standards Board, IASB, and the organization that houses IASB, the IFRS Foundation, have published papers clarifying that where climate-related matters are considered material, these should be reflected in the financial statements. Similarly, investors have been very public with their expectation that they do consider climate-related matters to be material and expect companies to be appropriately reflecting this in their financial reporting. And equally, this is very much on the radar of the audit profession, both the audit and assurance standard setters and the largest audit firms themselves. And perhaps we can hear Paul's views on this later on. So with this in mind, last December, with the support of our Climate Accounting Standards Group, CDSB developed practical guidance to support preparers in integrating climate-related matters into their financial statements. Integrating climate into financial reporting is something that is new for most companies. Now, something I mentioned in the last webinar that we held a few weeks ago, but worth noting again. Last month, Client Earth published a report finding that of the 250 largest companies listed on the London Stock Exchange, only 4% made a clear reference to climate-related factors in their financial accounts. So clearly, there's some way to go here. Now, to be clear, the CDSB guidance does not create new accounting standards in relation to climate-related matters, but builds on the position of the IFRS Foundation and IASB on how climate-related matters should be integrated into financial reporting based on current IFRS standards. The first chapter of the guidance explores why climate-related matters are relevant to financial reporting. We covered this in detail during webinars held in November last year, where we learned what IASB's thinking was on this, how investors are approaching this, as well as touching on the role of auditors. 2 weeks ago, we held the first webinar on this session exploring the key considerations under IAS 1 and IAS 37, as well as some practical considerations as to how companies can begin to integrate climate-related matters into their financial reporting. On IAS 1, the presentation of financial statements, we covered how disclosure requirements on sources of estimation uncertainty, as well as the standard being a catch-all for the disclosure of any matters that are not covered by any of the other IFRS standards, both of which we'll touch on again today. On IAS 37, provisions, contingent liabilities, and contingent assets, we explored environmental provisions, how net zero or other climate-related targets should be treated, and onerous contracts. Both the November and February webinars are available to view on demand on the CDSB's YouTube channel. Links are in the chat at the moment. and this session will be uploaded there as well afterwards. Now, moving on to today's session, we'll be looking at IAS 36 and IAS 16 before covering some takeaways on how companies can begin to integrate climate-related matters into their financial reporting, before ending with some questions for our speakers. So with that, I'll pass over to Paul and Barbara, who will talk through the matters that companies should keep in mind when it comes to climate and IAS 16, IAS 36. Over to you.
Thanks, Sundip, and thank you for the invitation to take part in this webinar. We believe it's such an important topic at the moment. We're receiving a lot of questions from our clients and other organizations around how we fit accounting rules and climate change developments into financial statements. And I think one of the areas where we do have most questions is around impairment of assets. There's a key fundamental principle within IFRS accounting, which is an asset must be recoverable to be recorded as such on the balance sheet. And there's been a lot of concern over the last few months and years over companies recording what they sometimes could be called stranded assets on the balance sheet, so balance assets which will actually never ever have their value recovered. Now, IFRS is set up to avoid that kind of thing happening, and it's set up to avoid that kind of thing happening by IAS 36, which deals with impairment of assets. So we're going to do a deeper dive into IAS 36 and climate over the course of this webinar. We're going to start off by thinking or reminding ourselves how the impairment assessment is made and what calculations are done in order to work out an asset impairment. We're then going to look at some specific climate-related examples. We're going to have a look at physical climate risks. Then we're going to look at what I often think of as transition climate risks, things such as how consumer behavior will change, how government action may well affect companies, their operations, and therefore the assets that they report. We're going to have also a think around cash flows beyond the forecast period, how those tie into our impairment calculations. And then we're also going to take a look at some impairment disclosures and how those should be impacted by IAS 36 and the interaction with climate and climate change. So perhaps we can move to the next slide. So let's just have a quick reminder of what IAS 36 requires us to do. First of all, there's a requirement to think about external and internal indicators of impairment. So you don't have to do an impairment test for all of your assets at every balance sheet date, but if an indicator of an impairment exists, you do need to do a test. There is an exception, of course, for goodwill and assets which don't have a determinate useful life, where a test is required every year. But in general, things like property, plant and equipment, basic CGUs, all of those would require testing when there's an indicator of an impairment. Now, there's a whole range of indicators of impairment. Some of those are internal, some of those are external, some of those have very little to do with climate change. For example, changes in interest rates could be deemed to be an indicator of impairment. But it's quite clear that what could happen with climate is a potential indicator of impairment. The standard talks about potential adverse changes in the environment in which the organization operates. And so that's squarely within those boundaries. We then have to think about when we do an impairment, and also perhaps just to comment, we also have to think at what level we do an impairment. We talk here on the side about whether an asset is impaired. Sometimes we'll do a test of impairment at the individual asset level. Sometimes that individual asset won't generate independent cash flows, and therefore we have to build it up to what we call a CGU level, a cash generating unit level. And so there may be assets which are potentially at risk, which are sometimes covered by other better performing assets, and therefore the CGU as a whole may or may not have an impairment in those situations. And in order to do the impairment test, we always have to calculate the recoverable value of an asset. So that's, or of the CGU. So that's a term we'll use frequently over the next half an hour or so. Now, the recoverable amount of an asset or a CGU is always defined as the higher of two calculations. Number one, it's fair value, less cost of disposal. And there's a whole piece of IFRS literature around how to calculate the fair value, IFRS 13. And then there's the value in use, which is actually determined by IAS 36, which in very, very, very simplistic terms, is the present value of the future cash flows that that asset will generate. So what companies have to do is they have to determine the level at which they will do an impairment test, and then they have to work out these two values. And if the higher of these is higher than the book value of the asset, it would appear that there's no impairment, and they can move on. Now, of course, for value in use, when we talk about the present value of future cash flows, of course, future cash flows are by their nature uncertain, and of course, climate risk will be one of many factors of uncertainty over time. And therefore, calculation of that value in use will always be a highly judgmental and potentially controversial piece of accounting. When you do a value in use, there's the standard gives you some guidance around what you should consider making in the value in use calculation. Talks about the estimate of future cash flows from the asset, the first bullet we see there. The third bullet also is important, the time value of money. Those are your two building blocks, your future cash flows discounted by the present value of money. But then you also have to take into account the things which are captured in the other bullet points in the standard, which are the possible variations in the amount or timing of the future cash flows. Again, an area which can be impacted very severely by climate events. Price for bearing the uncertainty inherent in the asset. Again, an asset may well have uncertainty due to climate events. As such, may be illiquidity. So that's a quick recap of what IAS 36 is about. It's basically looking at your assets or groups of assets on your balance sheet and making sure that the company will be able to recover the value of those assets, and therefore you won't have what is often referred to as a stranded asset, where you put value on a balance sheet for something which will never recover value over time. So maybe let's think about some actual examples of this. So let's think about first physical climate risk. And when we think about physical climate risk, I often think about chronic and acute climate risks. There could be acute climate risks will be short-term events such as fires, floods, which so one-off events which may cause problems or damage to an organization. And of course, very important is the chronic climate risk, which is actually the long-term impact of climate change, the impact that will have on things like the water supply, sea levels, and temperature. When an organization then looks at its impairment testing, it needs to assess its cash flows, it needs to assess what will happen in the future, and needs to think about how those physical climate risks can bring potential variability into those cash flows. If they are considered indicators of impairment, you then go to the cash flow situation, and then you have to think about, when you make your impairment calculation, to what extent do either those chronic or acute risks actually change and drive differences in the cash flow? And should you put some consideration in your cash flow forecasting to think about those potential climate events? It's probably good at this point to think about an example of this. In the guidance that the CDSB published last year, there's an example around physical climate risk. Barbara, could you perhaps give us a few highlights from that?
Sure, thank you. Thanks, Paul, and thank you, CDSB, for having us speak today on this topic. I agree with Paul. There are more and more discussions around this, and it's an important topic, but one that's not easily addressed in accounting. Before I talk about the physical climate risks, I wanted to mention very briefly about indicators as well, because I find when we look at financial statements that impairment indicators are often missed out in disclosures. And it is an important discussion for management to have, and an important information point for investors. So, and you'll see in the guidance that there are a lot of examples of impairment indicators. So I won't go through all of them, of course, but examples B and C have some indicators, have some examples of indicators for the oil and gas industry and for the coal industry. Now, I know that these are extractive industries, but it's a good way of looking at how indicators can lead to a reason to do an impairment test. And it gives examples of some indicators, such as climate strategies that the company is looking at. So if the company has announced climate strategies, such as lowering their emissions, this could mean that the assets' useful lives are going to be affected, and also their values. There are also other indicators such as relevant regulations or policies that relate to these assets. So the phase out of coal can be an indicator of impairment of coal PP&E. Declines in commodity prices can be an indicator of impairment. We've seen in the past year how the effects of COVID have affected, or the effects of COVID have led to a decline in oil and prices, and that has led to some large impairments in some of the oil and gas industry, which basically reflect what we should and hope to see in the face of climate change as well. Expectations about product content could also be an indication of impairment. So if a customer is expecting a reduction in plastic or a product to have recycled material content, or they're looking at the product footprint, so maybe an electric vehicle, this could be an indication as well of impairment of assets. So although I mentioned the extractive industry, this is not exhaustive for that industry, nor is it just meant to be for that industry. And the examples that we reference when we talk in this webinar will be specific industries, but the examples can be applied to different industries. So please keep that in mind when we go through the examples. So going back to physical climate risks, as Paul mentioned, we have an example in the guidance that I'll talk about that shows how physical climate-related risks can be factored into the value and use calculations. And this example H refers to a brewery group. It discusses potential impacts of physical risks, such as flooding and drought, on the brewery's costs. So for example, in terms of cost of its raw materials, which it uses, which are here hops and barley, and the availability of the raw materials, which could be affected by flooding or drought. And also the quality of the water that the company needs to use in its production process. So flooding could lead to pollution of the water. And so if they, for example, have to purify the water, then they will have to incur costs, perhaps even ship it in from elsewhere. And these types of issues should be factored in to the projected cash flows when the value and use calculations are done. They may have other costs that they will incur, such as high risks. The high risks of flooding may also cause them to have to move their factories. And so that could be another cost they may have to factor into the projected cash flows. The example also talks about the inherent difficulty of estimating the timing of these issues and the likelihood. And we understand that that is a difficulty for management, but one that management will have to consider. As Paul mentioned, the projected cash flows will, inherent in these projected cash flows are uncertainties, but that could be something that management will disclose when they talk about the items that they've considered in their projected cash flows. So management in this case will have to use its best estimates when it's projecting the effects of things like physical risks on future cash flows, as well as the timing of these cash flows. And of course, management should also consider disclosing these assumptions and estimates that it considers when it's doing an impairment test, which we'll talk about a little bit later, even if there's no impairment loss. And I'm talking about this from the aspect of it being material issues to investors, which is something I think that was discussed in the last seminar or in the last webinar with respect to IS1. So we go back to Paul on the next slide, please.
Thanks, Barbara. That's an example of physical risk and how the physical risk of climate change can have an impact on impairment. The next couple of examples we want to look at are not so much focused on the direct physical risk, but what I mentioned earlier, I often think of as transition risk, thinking about shifts in society and shifts as we move away from a high carbon economy and into decarbonization. There's going to be a whole host of factors and movements in business and the economy as we move over to a low carbon economy. We've highlighted a couple of examples here. I'm going to talk about consumer behavior now. We've also thinking about government action in our next slide. Clearly not exhaustive. I mean, there'll be huge potential changes, for example, in the cost of resources, the cost of production for a company. So these aren't the only transition risks, but we thought these were two good examples to bring out impacts on the financial statements for the audience today. So the first one is looking at changes in consumer behavior. So remember, one of the building blocks of your impairment calculation is the discounted cash flow. The discounted cash flow obviously considers your sales and your costs, and therefore you have to have a consideration of what your future sales will be over a long period. Now, that means you have to think about how consumer behavior, if you're a direct consumer business, is going to change over time and how that will be impacted with climate change. We see in some situations that it takes government action to drive differences in consumer behavior, but sometimes consumers will lead and governments will follow. So businesses can be caught out by changes in consumer behavior, which, especially in the current environment with rapid communications and social media, can happen very, very quickly indeed. So when companies look at their discounted cash flows, they do need to think about the best estimate of how consumer behavior may change due to climate-related matters, and that could be either positive or negative changes. Classic examples would be low-emitting cars or electric cars, and how those will be taken up by consumers and how quickly that take-up will happen. And the contrary will be more polluting cars and internal combustion engine diesel vehicles, how quickly consumers will move away from that kind of product. So it can be, climate change in these situations can be a source of positive news for cash flows or negative news for cash flows. And it's not just all around the consumer, and we often think about the supply chain as well, and how changes within a company's supply chain will be moved by societal expectations. For example, raw materials, extraction of raw materials, how those will come about, energy to make products, for example, whether that will be sourced renewably, whether there'll be an expectation for you to show zero carbon footprint all through your supply chain. Therefore, societal expectations rooted around, in my view, your sales and what will happen to your products and their sales profile going forward, but also really important to think about raw materials in your supply chain down through the organization as well. Hand back to Barbara, because we've got quite a long example. You're going to pick out some elements of example I from the guidance in this as well, I think.
Thank you. So yes, we are going to look at example I and from the guidance for this, and a few of the other slides as well. And example I is really interesting. It has a lot of facts in it and a lot of issues that you might encounter in looking at recoverable when you're doing the recoverable amount testing. So the example I discusses an automobile manufacturer. This company manufactures vehicles that run on internal combustion engines or petrol or gas for those in the US. And so most countries in which this company sells its cars have announced that they will be phasing out the use of petrol vehicles for over the next, say, 20 years. And actually, I should say that I will be talking about changes in consumer behavior in this example, but they will be based on consumer preferences as well as government policies, as you'll see in a moment. So the countries in which this company sells its cars are also going to institute interim policies that will help them transition into this phase out. And some of the interim policies can be things like a carbon tax on the fuel from the point of the distributor or the petrol station, which will most likely be passed on to the consumers, or government subsidies offered to the consumers so that they can be influenced to buy electric vehicles. So change in these, as I say, and other types of policies will most likely can affect consumer preferences, will affect their behavior, will drive a large part of the change in their behavior. And actually, the company has already noticed that consumer preferences seem to be shifting. And along with this, the company has not yet implemented its own emissions strategy or targeted how it's going to reduce emissions, nor has it decided that it will manufacture electric vehicles. So with all these things in mind, the company has to think about, well, what does this mean for the evaluation of their assets? And they need to look at, these are indicators of impairment, so they have to go and look at the recoverability of their assets. So especially for the factories, the technical equipment and machinery that they use in manufacturing these vehicles. So the things that the automobile manufacturer is going to consider with respect to consumer behavior, and which these changes will impact their forecasted revenues and their margins, as Paul has said. Will be things like changes to consumer preferences again, as I mentioned, and so variations in future demand, which will impact their future cash flows. For example, again, the company is noting that customers or consumers that are concerned about pollution are starting to use more public transportation and less cars. And I should say that when the company is considering these issues, it has to make its best estimate to forecast these changes and its expected variations in these cash flows. And it's decided it will do so by brand of car and most likely also by country, because that's where the policies and the consumer behavior will be broken out. The company is also going to think about the timing of changes in behavior in reaction to these policies. So based on research, the company has noted that there may be an accelerated decline in demand closer to the period or the time at which the policy will be implemented. So it has to think about the timing of the changes to its cash flows, cash inflows, with respect to the timing of when they think the policies will come into effect. It is also going to think about the cost of electric vehicles. As I mentioned, subsidies to consumers will encourage consumers to buy these vehicles. And so the more these costs go down in comparison to petrol cars, it's possible that the more quickly consumers will purchase the electric vehicles. And so the company has to consider how this will also affect its cash flows. It also has to think about, with all this will change perhaps its percentage customer base in each country. And so it has to perhaps apply a percentage to the changes in cash flows or to the cash flows, depending on how it looks at these cash flows. In order for management to make these estimates, they can look at projected changes based on research. So there are published policy scenarios by region, such as the inevitable policy response research that has been done, and that could help companies make these decisions. And they can also look at market research on consumer behavior and then apply again an estimated percentage change to these cash flows. So I'll move back to Paul for the next slide.
Thanks, Barbara. So we've taken a look at expected changes in consumer behavior as one particular source of variation in cash flows. The next thing we want to talk about is expected government action. And again, we'll open this up with an example, but the thing I wanted to stress from a technical point of view is we're looking at expected government action. Now, the accounting geeks in the audience might realize that sometimes we wait for legislation to be passed before we account for it. A classic example of that would be deferred tax rates. And so there's often a voice which says, well, we shouldn't really think about government action in the future until it's actually been enacted. So until a carbon tax has been brought in, for example, we shouldn't really consider that in our cash flows. That would be mistaken. IAS 36 is very much about forecasts and a company's intentions, but a forecast of future events. So the fact that governments have not necessarily enacted legislation, if the company believes that they're expected to do so either in the short, medium, or long term, pretty much any time for which it has cash flows supporting the asset, that government action needs to be considered in the cash flows. And there's a multiple number of different types of government action that could come through, as we've talked about, the carbon taxes, changes to changes to fuel types for vehicles. All of those are present here in the UK, either as proposals, as talk, or as government ideas. In different jurisdictions, there'll be at different levels of maturity as well. So companies need to think about this in all of the jurisdictions where they have operations and really make an idea and or make an estimate of how they think governments will react and what they think their best estimates will be around government action, and then find a way to incorporate that into their cash flows in their value and use calculation. So Barbara, do you want to pull out some more from the example on this one?
Yes. So back to example I, which is the automobile manufacturer. So, and as you've heard Paul say, and also in the last slide, some of the government or expected government policies could affect or influence consumer behavior. We're gonna, now this discussion looks at some other policies. So as part of the transition to phase out petrol vehicles, some of these governments may also institute a cap and trade scheme for car manufacturers, where before the phase out, these manufacturers may have to purchase carbon credits based on the number of petrol cars they manufacture. So this automobile manufacturer may be subject to a cap and trade scheme for certain countries in which it sells its cars or where it operates. Other countries in which this company sells its cars may not phase out the use of petrol cars, but they may instead implement stricter emissions regulations so they can lower pollution. So this company, in order to estimate its projected cash flows for its impairment, is management's again going to consider the expected timing of these policies. And as Paul said, about the enacting versus the announcement versus the enacting of the policies, yes, they still have to consider the effects on cash flows, even though they've not yet been enacted. And management can consider the history, the country's history of enacting these laws and enforcing them once they're announced as part of its estimates to changes in cash flows. So management's going to have to think about the variation of future cash flows based on the actions of the different countries and the policies of the different countries in which it sells its cars. It's also going to have to factor in the estimated costs to comply with the emissions regulations or cap and trade scheme. So what are the costs of carbon? What are carbon prices? What might they be versus what could be the cost of paying the penalty if they're not able to buy the emissions, say the emissions trading certificates. They also have to think about their ability to react to the policies in those countries. So for the countries that are still allowing the sale of petrol cars, but with higher emission standards, the company has to think about whether they will be able to retrofit their cars or somehow their manufacturing facilities so that their cars can also comply with lower emissions, so that this company can continue to sell its cars in that country, and how that might affect their cash flows, the timing of their ability to retrofit their cars. I think that's, yes, so let's go to the next slide, Paul.
Thanks, Barbara. Now, want to think in a little bit more detail about cash flow modeling and how that works in an impairment test. Traditionally in an impairment test, and IAS 36 is very clear that when a company forecasts future cash flows, it can use budgets and forecasts for the organization for a maximum of period of 5 years. But after that, it's difficult to, or the standard discourages companies from using budgets and forecasts, and tends to say that you ought to use perhaps a growth rate which is similar to the growth of your particular business over time, kind of a historical growth rate, or perhaps a historical growth rate of the economy in which you operate. And there's good reasons behind that, because in traditional impairment tests before we focused on climate change, a lot of the impairment tests would be about future product development or future movements in a product, its ability to gain market share, its ability to be marketed and be successful. A lot of that will be perhaps quite optimistically forecast by the company over a period of 5 years, but they'll have some backup for that. But beyond the 5-year period, it's quite difficult to do that. And therefore, the IASB has always said that after 5 years, you really need to be careful and you need to stop the rigor of your forecasts at that point and perhaps to apply a long-term growth rate. Well, that was a message which a lot of preparers received. That, though, gives us a problem when we start to think about climate and the impact of climate, because, of course, the impact of climate, we're seeing it in the shorter term, but the key impact of climate change will be of a period much beyond the 5-year window. And therefore, that gives a potential problem in testing, which I don't think actually exists, but we want to make sure that people are aware of the trap that you can fall into, which is that if you only look at your 5-year budgets and then apply a long-term growth rate in a number of industries, you will completely miss a lot of climate, both physical and transition risk for climate, because a lot of those events will occur, perhaps some of them in the short term, but a lot of those will occur in the longer term. So here we say, and if we can move on to the next slide, I think we go beyond this point. So the cash flows beyond the forecast, actually should be modified to incorporate the anticipated timing, profile, and magnitude of the effects of climate change, because the standard is quite clear that if beyond the 5-year period you can identify risks to your cash flows and potential volatility in those cash flows after 5 years, you should do that. So when you're looking at climate risk in your modeling, although traditional impairment models have a lot of detail for years 1 to 5 and then fall off in the detail quite dramatically after that point, you need to encourage your modeling teams to have a shift in thinking and to make sure that for the years 5 going forward, the impact of climate change is thought about, because as I say, it's such an important factor, not just in the short term, but also in the medium to long term. And once you start thinking about that and thinking of climate change, a whole host of examples come in. For example, in your cash flows, you'll be looking at residual values of fixed assets, but climate could impact the residual value of fixed assets. For example, imagine you have a diesel truck fleet for which you've got a residual value coming in years 3 or 4 in your cash flows. But then you need to think about, well, will future legislation, for example, in that situation, impact on that cash flow because the value of diesel trucks will fall. That's one example here. There's more examples, Barbara, in example I in the guidance. So perhaps you could talk a little bit about how we've thought about cash flows beyond the forecast and budget in that example.
Sure, we're back to our friendly example I. So the company knows that the policy changes are expected to occur over the next 20 years with bans by 2050. So management knows, as Paul said, that the changes to projected cash flows are going to extend out past this 5-year forecast period. So again, as Paul mentioned, when management estimates the variations in their cash flows, they have to extrapolate the forecasted cash flows, but they'll have to modify them for the estimated changes in timing and for the extent of the effects of climate change. So things that management will have to consider will be, again, the expected timing of policy enactment, the expected timing of changes to the consumer behaviors, the useful lives of the assets, whether or not they can extend out these useful lives to the ban period, additional operating costs to modify the products, and again, the timing of this that extend out past the 5-year forecast period, projected changes to carbon prices and the timing at which these changes could come in past, again, the 5-year period, projected changes in oil prices, and again, the resulting loss of revenue, and whether the margins that they have in some of these countries will be significant, will be sufficient enough for them to continue to operate in those countries. As I mentioned before, there could be a delayed response to policy changes, and so that there may be an acceleration of reaction to the policy at a later date. So as the forecasts get closer to 2040 or 2050, management may have to show that effect in its cash flows when it modifies the forecasted cash flows. And for management to be able to better estimate, obviously these are going to be estimates, how the above issues or how these issues that I just mentioned will affect their cash flows beyond the forecast period. They can, again, research these issues. They can speak to regulators about the timing or governments about the timing of these policies. They can research consumer behavior. They can, again, look at reports that are published that I mentioned, such as the Inevitable Policy Response or International Energy Agency reports with projections. And again, they can look at the timing based on different countries they should do that. And as Paul mentioned, they'll look at the residual values of the assets and the cash flows that those residual values may or may not bring in, depending on the timing of these changes. But we'll talk more about the residual values in the next few slides. Back to you, Paul.
Thanks, Barbara. We're going to now have a think about the impairment disclosures, and I think it's fair to say that this is perhaps one of the more controversial areas within climate reporting within the financial statements. There's a whole host of stakeholders will look through corporate reporting, trying to understand impairment disclosures, and quite often feel frustrated that they can't get the information that they'd like to have from that reporting. A couple of points that we want to highlight in this area. As we note in the first bullet, although the standard does the rather strange thing of encouraging disclosure for around assumptions used to determine the recoverable amount of CGUs, those assumptions are only required for the impairment testing of goodwill and intangible assets with an indefinite useful life. So for other assets which have been tested for impairment, if they've been given, quote unquote, a clean bill of health, there's actually apparently or no real disclosure requirement, although there's a disclosure encouragement. And so a lot of companies perhaps will do the impairment test, but then decide not to disclose how they did that test, what assumptions they made to do that, in order to give the conclusion that they didn't have an impairment. What I think it is important to think about, though, is if you go back to IAS 1, in general terms, in any part of the financial statements, even if a disclosure statement isn't required by a particular standard, there is a catch-all requirement that says that it would be expected if it was deemed material by the users of the accounts. So, for example, if a company had a group of, let's imagine, coal-intensive assets or coal mines or coal power stations, which clearly would be under threat from structural climate or transition climate change, they may well do an analysis of those assets, and they may well come to the conclusion that no impairment is needed to be recorded. And therefore, on the face of it, they could say, well, as I don't have an impairment, I'm not required to disclose how I came about that conclusion using the I'm not required by IAS 36 to give the disclosures about how I came about that conclusion. I would challenge that, because I'd say if people were aware, if users were aware that you had assets which were under threat by climate change and the value of which was under threat due to climate change, even if you don't have a write down in that particular area, the users would expect you to give information around how you came to that decision. And therefore, so for example, in my situation of a company with some coal heavy assets, which it determined were not needed or did not have an impairment, I would argue there should still be an impairment under IAS 1, not under IAS 36, because the users would require that. If we move on to the next slide, we can then talk a little bit about what those disclosures would look like. And again, we'll move on to an example with Barbara in a minute, but there's a whole, I guess, host of examples so that a user of the accounts can really get under the skin of the calculation and work out what the key assumptions were in order to work out the recoverable amounts. So how the cash flows were determined, how the discount rates were determined, what the period that was looked at, thinking about growth rates, justifying any growth over 5 years, also thinking about climate impact over 5 years, as we just talked about in the last topic. As I mentioned, thinking about growth beyond that period, if it extends the long-term average. So a whole host of disclosures need to come out in order for users of the accounts pretty much to understand management's thinking in this area, and of course, work out whether if they had different assumptions, whether or not they'd see an impairment, and their view on the riskiness of that particular conclusion from management. So Barbara, in example J, we've moved on examples now. I think we've got some more guidance around this area.
Yes, we're in a new example now. We're in example J, and a lot of what Paul mentioned is illustrated in this example, which talks about a hotel group which has recorded some goodwill because it has acquired some small hotel brands, and these brands are located in islands that have significant risks from the effects of climate change, physical risks from climate change. So for the impairment testing in this situation, the hotel group has thought about changes to travel, changes to consumer travel or customer travel that might result from changes because of the physical risks that are affecting flights to these islands, shorter holiday seasons because of the impact of significant either acute or chronic physical risks that are happening in these islands. And so there may be less revenues as a result, less customers coming. And so of course the margins will be lower, and increased risks of natural disaster and business interruption. They may have to also close the resort because of these physical changes. They may have, again, less consumers or less customers come out because of these risks. And as a result of these risks of assets, they could have higher cost of capital. So they have done an impairment test. There is an impairment loss. In this example, because there's a material amount of goodwill that has been recorded, these disclosures that Paul talked about would be required. So pretty much all the disclosures that Paul mentioned would be required. The growth rate, the discount rate, the assumptions that were used, changes in the assumptions, the sensitivity analysis, the reasons for changes in the cash flows and the considerations that management made to determine the cash flows. Management would also probably want to explain that there is an increase in estimation uncertainty that's caused by these climate change assessments, the recoverable amount of the impaired cash generating unit or the asset, the losses incurred. As Paul mentioned, these would be required because goodwill is included in this, but I will go off piste for a minute and reference also the annual reports that we have been looking at. And a lot of these, as Paul has rightly said, may not have impairments, but they're in carbon intensive industries. And so investors want to understand the assumptions that have been used in the impairment tests. And these are not being disclosed today. And this is material information for investors. And so when you reference IAS 1, the assumptions that are used, sensitivity of those assumptions to, or sensitivity of the assets to changes in those assumptions, the projections, what have affected the cash flow projections. This type of information is important for investors to understand how the company is managing these risks and managing its assets. And so I would argue, as Paul said, that these disclosures are important, not only if there is an impairment loss, but maybe even more important when there isn't an impairment loss and there's less information provided to investors. Back to you, Paul.
Thanks, Barbara. And I think the last practical example we're going to look at is moving away from IAS 36 and moving over to IAS 16, property, plant and equipment. Now remember, an item of property, plant and equipment, if it generates independent cash flows, could be tested for impairment under IAS 36, and therefore the accounting value of that asset could be impacted by IAS 36. Absent that, two main ways or main focuses you need to think about for IAS 16 assets due to climate change. And also worth remembering that there is a IAS 16 requirement that each period end, companies should sit down and think about whether they've got the right useful life for their assets and whether they have the right residual value for their assets. And if they don't have that, they need to adjust it. So it could be that you have an asset with a 10-year useful life that you need to reduce, and then you might have an asset with a substantial residual value which you may need to reduce. And again, the reductions in useful life and reductions in residual value would come about through principally, well, some of the risks that we've already talked about. So if you have a coal-powered fire station and there was legislative change coming in mid-2020s for that, you would need to make sure your depreciation period for the power station rather was consistent with the government policy. The other point to make is, as I said, if assets or if fixed asset items do have independent cash flows generated by them, if you are changing your useful life and if you're changing your residual value, you may well find yourself that that's an indicator of impairment as well, and may find that you need to do an IAS 36 test to look at the actual balance sheet value of those items, because of course changing your useful life and changing your residual value at the balance sheet date doesn't actually impact the balance reported at the balance sheet date. It just changes how quickly you get down to zero or the residual value in the future. So once again, there's a couple of examples of this in the guidance. I think there's example K&L. So pass back to Barbara, she can talk a little bit about those.
Yeah, so we're mixing it up now. We have two examples for this one. Example K talks about an airline group that has announced pledges to reduce its emissions. They've pledged to reduce 30% by 2030 and move to net zero by 2050. So we found this to be an interesting one when we were looking at this, because the residual value is affected. It may not be affected in the ways in which we think it would. So just because if the useful life is reduced by the airline because they're not going to be using the asset for as long as they thought, doesn't mean necessarily that the residual value will be higher at the end of that useful life. It also depends on other factors that are going on, which I'll talk about now. So as part of its pledges, the airline's phasing out its most polluting aircraft. It will phase out the use of these aircraft by 2030. And it had purchased these aircraft 5 years before. And so when these aircraft were purchased, they had a useful life of 25 years. The residual value was 10%. As a result of the pledges that the company has made, it has reviewed the useful lives of these assets, as I mentioned, and because they're going to phase out these aircraft by 2030, they note that now the remaining useful life of this aircraft will be 10 years instead of 20 as it would have been since they purchased the aircraft 5 years ago. So it is now going to review the residual values of the aircraft. And it does this by thinking about other emissions commitments that were made by its peers. And so whether or not its peers would actually be able to or want to purchase these assets when this airline has stopped using them. It's thinking about changes to regulations and whether these assets would be useful to others again after 10 years. Consumer behaviors could affect the residual value as well, and whether consumers are traveling less by air, change in technology, and whether in 10 years these assets could be retrofitted to use different types of fuels. And so in effect, whether there would be a secondhand market for these assets in 10 years based on what else is going on in the industry. And then of course, they would have to consider whether these assets are impaired. So another example that we've referenced with respect to this, and again, talking about the useful lives and residual values, is a haulage transportation company. So effectively a company that makes big trucks that move things around. And the company is thinking about the effects of transition risks on its fleet. Especially, what it's especially considering is that there's a current ban on large diesel trucks used in certain EU cities. And so the company is thinking about whether this ban will spread to other cities and regions and how it's going to affect this company's assets, as well as the secondhand market for these assets. So company has to think about the useful lives and the residual values of these assets. So as part of thinking about how these issues are going to affect their business, the company has assessed or is considering two different solutions. One of the solutions would be to sell its older, more polluting trucks today and buy new ones. So this would give the company a more flexible fleet, but perhaps there will be higher costs today because it's laying out costs to buy new trucks. If they decide to do this, their useful lives will of course be impacted, will be shorter. Cash outlays will be sooner than expected, but they will also have cash inflows from selling the assets at a higher residual value today. They would have increased depreciation until these trucks are sold, which of course would affect the P&L, but they may not have any impairment of these trucks. Alternatively, if they decide to keep the older polluting trucks around and use them in more rural areas, then they might have a longer life for these trucks, but they may use these trucks less today because they need time to get them to the rural areas. In that case, they might prolong the useful lives, which would have a lower depreciation expense in the future, but then there may be a lower scrap or residual value for these assets. And these assets, these trucks could also be impaired. So there are a few things that these companies have to think about when they're considering the residual values and the useful lives of these assets. Back to you, Paul.
I think this is me now. And at first, I just want to say thank you both, Paul and Barbara, for your insight. And one of the things I've taken away is that climate always needs to be considered as part of any forward-looking information that is being embedded in the financial statements. And as has been mentioned a few times, climate change is inherently uncertain. But the fact is, preparers, companies are already having to make the best judgments and estimates based on information that is available to them when preparing financial statements, and provide that additional analysis when it comes to key assumptions. So considering climate and embedding climate into this thinking is not fundamentally different, albeit it is a new challenge. Now, before moving on to the Q&A, I was going to run through a few of the practical takeaways that we cover in Chapter 3 of our guidance. In the interest of time, I'm not going to go into this in detail, but what I will say, do look at Chapter 3 in the guidance, because we kind of do cover this really nicely, and some kind of practical tips for how you might want to begin or progress in integrating climate into your financial reporting. And with that, let's now move on to the question and answers that we have for Paul and Barbara. So first question for you, Barbara, something I know you were previously involved with. How seriously are investors actually taking this? Are companies beginning to, in relation to how companies are integrating material climate-related matters into their financial reporting?
Sorry, I was trying to find my mute button. Investors are taking this seriously. You mentioned the letters that were written. I think you mentioned the letters that were written last year by different groups of investors. There were two groups that effectively wrote letters. One was large asset owner organizations worth over 100 trillion in assets under management. The other was a group, IIGCC, that wrote letters to 36 EU companies. Both want better disclosure of climate-related issues in company financial statements, and they're writing to companies that are carbon intensive, working in carbon intensive industries. What are they going to do about it? Well, we're doing some analyses today for some of these investors, and my understanding is these investors will, depending on where the company is in a spectrum, so disclosures, consistency, that's another issue that's quite important for investors, is if a company is consistent between the front and the back end. These investors will try to engage more with the company if they think they can make change. They will very possibly vote against the company, against the accounts, against management. They may even vote against auditors if they're very, very upset about what's happening. Sorry, Paul. Or they could, if they're in a situation to do so, that they could or will divest. So they are serious about these issues. They're very concerned, and this is also happening in the US.
Brilliant, thank you, Barbara. Thank you, Barbara. And it's a natural question for you then, Paul. Could you give us an insight into how the audit profession is approaching this question? And I'll tack on the second question that's come through as well. What role do auditors have compared to management in ensuring entities start considering climate change risks as part of the impairment reviews?
To the first part of the question, and just to also build on Barbara's comments, we're under absolutely no illusions how important this issue is for the stakeholders, and we are very clear that everybody, all parts of the corporate reporting environment, need to focus on this issue quite deeply over coming reporting cycles, and that's not just auditors but also boards, companies, professional bodies, investor groups, etc. And we are, I think the audit profession as a whole, not just my organization, is very eager to make sure that the financial statements in particular, which is what we primarily look at, are consistent with the guidance put forward by the ISB and the educational material that they've put forward. Some of you may have seen the letter from the Global Public Policy Committee, which is an umbrella body for a number of the large audit firms, welcoming both the ISB's intervention and other interventions by the various audit bodies and regulated bodies in this. Within my organization as well, we've conducted a large training program for all auditors, and everybody involved in audit engagements will understand about climate change, will be given training, will be given guidance. A lot of the material that we've gone through on the webcast is material which is given in training sessions to our engagement team as well. And we also employ climate specialists within the organization who are very often linked in with audit teams in order to challenge the audit teams, who will be made up of more traditional accounting skill sets, to make sure that they understand the risks and the potential impacts for this. So there's a whole range of initiatives which I think are happening both from an audit team level to a firm level to a general level, both of auditors and the wider ecosystem of corporate reporting. And it's, I think, quite marked how this area has really hit people's imaginations and concerns in the last 3 to 5 years.
Brilliant.
I think that there was a question around the role the auditor has compared to management in ensuring an entity starts doing impairment reviews. I mean, the classic auditor answer to that would be, and I think it has to remain to be, that actually they are management's financial statements at the end of the day. But that's perhaps the easy response. The more nuanced response would be we work and discuss and we challenge our clients all the time, and part of our role is to make sure that clients have robust challenge, and to the extent that the client hasn't incorporated climate factors into their accounts process is an area that we have a duty to challenge and to be skeptical about the conclusions on.
If I might add to that, I think that, well, of course, that's an important distinction that people need to remember, that they are management's accounts. But at the same time, investors would like to see information in audit reports about key audit matters. So if there are discussions and challenges that the auditors have to make of management assumptions, then investors would appreciate understanding how the auditors have challenged management, and how maybe auditors have done their own sensitivity analysis, or maybe bring in, like you said, external or internal specialists to deal with this. So as part of the audit way of challenging management, it's good for the investors to understand how that's affected the audit work.
Brilliant, thank you. We do have some really juicy questions that I would have loved to get into right now, but we are unfortunately out of time. So with that, we're in the Q&A there. And quickly, just to finish off, the link for the Accounting for Climate Guidance should be coming back on screen now. It's already been shared in the chat. So do take a look at that if you haven't. There are some really excellent illustrated examples that Barbara and Paul were involved in developing, something that Barbara obviously covered earlier on. And this broader area remains an area of focus for us at CDSB. So we would love to hear your thoughts, comments, feedback on this area of work to help us kind of figure out what we should be focusing on going forward. I'd like to thank our speakers today, Paul and Barbara. Thank you very much for joining us. Thank you for your time. And finally, to our attendees, thank you very much for joining us today. And I hope you stay safe and well. Goodbye.
Thank you.
Thank you.